All right, why don't we get started? So thank you guys very much for joining. I'm Mark Lamonic. I look after the individual investor team for Morningstar here in Sydney. We're going to talk about market crashes today, but we're going to talk more about sort of bear markets and lessons we can take from this. So back before our current bear market, we did these things a little bit differently, basically warnings about valuation levels. But now that we are in a bear market, we'll just look at that and some lessons we can take away from it. But first, a couple of housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're in New Zealand, get a copy of our FAP on our website, morningstar.com.au, and the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. All right, so let's get started. You, of course, can listen to our podcast, follow us on Instagram, and you can sign up for the wait list for our conference. So October 13th in Sydney at the ICC, also available for anyone who wants to stream this from home. If you join the wait list, you will get our best prices for the conference. And the wait list is filling up. So if you do want to go to the conference, get on that wait list. Make sure you're going to get a ticket. Emily is going to be very kind and drop the link to sign up for the wait list into the chat. So if you could do that, Emily, I would appreciate it. And yeah, hopefully we'll see you all there. All right, so let's get started. So we're going to talk about bear markets first, and that is Ted from the movie Ted. Trying to find a picture of a bear. So let's talk a little bit about bear markets. So for those of you that have not been living in a cave, we are currently in a bear market in the US. We have not reached it yet in Australia. Bear market basically represents the market falling 20% from its low. So I think June 14th was when we crossed over in the US into bear market territory. But this is not unusual. While it can be upsetting, of course, and stressful as investors. Since 1928, the S&P 500, so the 500 biggest shares in the US, that index has experienced 27 bear markets, which means that this happens every 3.5 years. Now, we did go on a very long streak without a bear market. Then we had the COVID crash, which was the shortest bear market in terms of recovery. Now we find ourselves back there again. But remember, this is, even though it can feel stressful, this is not something that is that unusual. So the average length of a bear market is 9.6 months, 289 days. Now we'll look at a different figure. That's if we go all the way back to 1928. They've actually lengthened a little bit. If we look at a 1960 figure, which we'll look at in a second. So the end of a bear market, of course, represents, and you don't know this at the time, but a bear market ends when stocks hit a low and then at some point move on to a new high. Now, on average, if we go back and look at different bear markets, it's taking 19 months. So more than a year and a half for shares to go back and reach that previous high they were on. So I'll spend a little more time talking about this. And it's not that important, I guess, at the end of the day, but just sort of understanding how we define a bear market. Historically, there's a lot of talk right now, of course, is will central bank policies be pushing a number of economies or economies around the world into recessions? Only about half of all bear markets have also included recessions. So remember, the share market and the real economy are different. And a fall in one does not necessarily mean that we're going to see damage in the other. The other thing that is important to remember is that there is a lot of volatility. Of course, as any investor in shares, there's a lot of volatility, but there's a lot of volatility within bear markets as well. I think when we go back and look at things historically, whether it's a new market high or whether it's a bear market, for some reason, we forget about all the volatility that we experienced during those times and think of the market just falling to a certain point and then just raising to a certain point. But obviously, that's not happened. So yeah, half of the S&P 500 strongest days in the last 20 years occurred during a bear market. Another 34% took place in the first 2 months of a bull market. And remember, the first 2 months of the bull market, as I wrote right here, it was not clear that that was a bull market, right? All these things that we described historically are not apparent at the time. So something important to think about. Oh, okay. So we'll put in the conference update or the conference wait list. All right, so let's look at the bear market since 1960. So I'm not going to go through every single one of these. I'll talk about some of the biggest ones, but a couple of things to look at on average, and we'll talk about how that impacts us now. On average, the market, as defined by the S&P 500, and many times Australia has, of course, followed the same pattern, has dropped 34.5%, just under 34.5%. During bear markets since 1960. Now, a bear market is defined as a drop of 20%. So obviously the market does not stop at 20. So another 14% loss after hitting bear market territory. And then the duration of a bear market. And let's talk about what this means. The duration of a bear market has been 332 days since 1960. Now, what this means is that, once again, none of this is apparent at the time, but what this means is from the previous high to when a low occurs, that is the duration of time. So let's use an example. Use the example of this 2020 drop. So shortest bear market in history. In February, so remember 2020, there's this thing called COVID that came out, very exciting. So in February, everything was going fine. And then, of course, there was this panic. So the market actually hit a new high. I'm sorry, using the American dates here, I should have changed those. Using in February, on the 19th of February, market hit a new high. And then we had this extreme plunge, right? So right smack dab on average, basically this 34% plunge that happened in March, where it hit a low on the 23rd of March and then started to recover. So in that case, the duration is 33 days. All right, so let's talk about what's happening right now. We'll look at our current bear market, then we'll get into some lessons to hopefully be more exciting. Okay, so as I said, a bear market occurs when the market falls 20%. We're measuring it from the day that it last hit its high. So right now, as I said, we crossed into bear market territory in the US on June 15th, but the bear market officially started on January 4th. So even though this has been a really trying time and difficult year for investors, right out of the gates, starting out 2022, the market did hit in the US, did hit a new high. So it hit that January 4th. And then, of course, we've seen that fall. And right now, because the market's actually done decently over the last couple of days, right now, the market is around 17% down, right? So across that 20% threshold, it's around 17% down in the US, less in Australia from that high, which means if we want to hit average, so this is just an average bear market since we've experienced since 1960, mean to fall another 17%, and the thing will end on December 2nd, 2022. So obviously this is not going to work exactly like that, but it's just something to keep perspective on. So especially as people sort of get around, we'll talk about why this is hard to do, start thinking about, okay, when's a good time if they have some extra cash, and when's a good time to deploy it. Remember, if we just hit average, we do have a ways to go. Now, if we go back and look at this chart, I did want to point out a couple bear markets that I think are at least interesting and big ones. So this big drop in 73, 74. So that is what's called the Nifty-Fifty crash. So the Nifty-Fifty was 50 shares, 50 growth shares in the US. And if you go back and look at the list, a lot of names that are still around. So everything from Pfizer to Johnson & Johnson, Pepsi, Coke, a lot of these sort of big, well-known quality companies that were bid up to these enormous prices. And then, of course, we had this crash. Now, what this crash started leading into is a period, if this sounds familiar, is a period of very high inflation. So basically, at the end of the day, as we sort of went into the 70s, from kind of, around this time, all the way until this Volcker recession in the early 80s. That's this crash right here. That's where the Federal Reserve in the US and central banks around the world, after almost a decade of inflation, finally decided, okay, well, we need to stop this period of time where we're continuing to see inflation, we're actually going to crush that inflation by jacking interest rates so high that we're going to push the economy into a pretty severe recession, which is what we had in the early 80s. So we had this other bear market right here. But, this is just, obviously, I don't know what's going to happen, but just sort of the last kind of global period where we had really elevated inflation was that period right there. The other one that we'll talk a little bit more about later is the GFC. So GFC, well, we'll talk about that later. But really what we're looking at here is these two events right now. And many people sort of characterize this period of time, and many consider this like the same bear market. But anyway, many people sort of characterize that period of time as the lost decade. So if we look at the 2000s, we actually had two different bear markets during the 2000s. We had the early one, that tech bubble breaking the beginning of the decade, and then we had the GFC. And those two events did lead to a negative return on the S&P 500 in the US over that decade. So it is something important to remember that, we'll talk a lot about how the long-term shares certainly go off, but we could, of course, have periods of time where things are very negative. And same thing here. We sort of look at this time period as well. This inflationary time period was not a good time for shares. And actually in the early 80s, there's a famous cover, trying to remember, I think it was on Fortune magazine, that said, is investing or is the share market dead? Basically, is there any reason to invest in shares? And then, of course, we had an enormous run since then. All right, so let's go back and look at history. And one thing that's important, and we'll talk about why this may not apply to certain people, but if we go back, investing in the share market, and this is the S&P 500, where we can see these various bear markets during the lost decade, which I just talked about. But $1 invested in the US share market at the end of 1870 grew to $20,514 in real terms, and that at the end of May, so 6.8% a year. Now, real, of course, means that we have taking inflation out of it. So that is a return on top of inflation. So something important to remember, everyone always quotes 10%. Right? Over the long term, the share market returns 10%. Well, we're interested in real returns, right? We're interested in returns in excess of inflation. It's one of the reasons why it's important to invest in the share market, but there you go, 6.8% a year. And, the point of this, of course, is this sort of idea of zooming out. And making sure that while we're very caught up with what's happening, just as investors were in all these other bear markets, very caught up with what's happening on a day-to-day basis, that as long-term investors, we need to have that perspective of zooming out. And hopefully that can eliminate some of the behavioral risks to investing, namely that you do something stupid in response to volatility. All right. We're going to go through some lessons. We'll spend some more time on these lessons, but I wanted to do an overview. All right. So the first lesson is, and I referenced a couple times, and obviously I don't know how everyone watching this is feeling, but I've referenced a couple times that, this can be a very stressful time for investors. Any bear market can be very stressful for investors, but the volatility, so basically the bouncing around in prices that occurs in investing in general, but particularly during bear market, will increase the likelihood that you, me, every other investor makes a mistake. And it is something that's, I think, important for people to understand, because hopefully just the knowledge that we're in an environment that increases investor mistakes will make us all try to be a little more thoughtful about anything we do with our portfolio right now. All right. And we have this study at Morningstar that I reference a fair amount. It's called the Mind the Gap study. So the Mind the Gap study, of course, is a little play on words of getting on the subway or the train or anything else. But yeah, the Mind the Gap study goes and looks at two different sets of returns. So it looks at investor returns. So that's what the average investor gets in their portfolio, what their return is, and then an investment return. And the way that we can do that is we can go and look at inflow and outflow data. So it's very easy, obviously, to see how a certain fund performs over the long term. All of that, of course, is published. But we can also look at inflow and outflow data, which doesn't directly impact anything with a fund price, of course, because there are mechanisms in there to prevent that. And we can compare those two different returns. And basically what we're looking at is what is the impact of timing decisions that investors make, when to buy, when to sell. And what we've found in this study that we do every 6 months, and if anyone wants it, I can send it to you if you email me at mark.lamonica1@morningstar.com. What we found in the study that we periodically do is, of course, investors get lower returns than investment. So basically, we collectively make poor decisions around timing that impact our returns. So we would have done better in aggregate. We hadn't switched from one fund to another. But of course, investors chase returns. Investors get spooked when markets go poorly, and it causes us to buy when we shouldn't, causes us to buy at the top of the market with very high valuations, causes us to sell during bear markets when we have lower valuations, because of course, our emotional response to volatility, that fear and greed that it drives, is causing those poor decisions. So if we go and we divide up funds and ETFs into 5 different quintiles ranked by volatility. So what are very volatile funds? So if we think about a volatile fund, it could be something like a technology growth fund, like our friend Kathy Wood at ARK Innovation. That's a very volatile fund, right? And then we can look at funds that have low volatility. So low volatility could be a balanced fund that also has fixed interest and cash in there to dampen that volatility. So if we divide up funds and ETFs into those quintiles, and then we look at the most volatile and the least volatile, we can see that this gap, this behavior gap, this gap in returns between the investment and the investor is 10 times as large, right? So investors in general, timing decisions do have a negative 0.19% impact on returns if we look at those least volatile. So even in the least volatile funds, our behavior is still causing us to underperform the actual investment. But if we go and we look at the most volatile, we can see that all of a sudden that's expanded to negative 1.86. And that is a lot. Like that is a lot. That is a annual return. And 1.86%, the difference in that over the long term is huge. So we can see that volatility causes us to make more mistakes. So what can we do about that? And we've been pretty vocal at Morningstar about this over the past 6, 7, 8 months. But what can you do about this? Well, you want to slow down your decision making, right? Realize that you are probably well, in some cases, I guess I would say, maybe probably is too strong. In some cases, your decision making during times of extreme volatility is based on your emotions. And we want to try to be as rational as possible as investors. And we aren't. Like as humans, we are not rational, but we want to try to be as rational as possible. So how can we do this? Well, slow down that decision making. Make sure that the decisions you are making are very deliberate. And the simple way to do this is to have a plan and to write down why whatever you are doing, whatever investment decisions you are making, is part of that plan and will help you achieve your goals. And just the act of writing it down, when I say write it down, actually write it down. Just the act of writing it down will clarify your thinking. The other thing, of course, you can do is run it past somebody else. So maybe potentially a partner or spouse, a friend, walk through why you are doing something. And just that whole process, of course, once again, slows down and clarifies your thinking. And, in many cases, you can decide maybe this isn't the best thing to do. And of course, the other sort of speed bump we can put into that decision-making to slow it down is just wait a couple days. Like I know we're all especially when the market's swinging pretty wildly, right? We had a huge down week last week until Friday, and Friday went better. And this so far this week. Things have gone okay, but remember, just slow down. The cost of making your mistakes, which we'll talk about in a second, can be pretty significant over the long term. So just slow down that decision making. Give yourself a couple of days to mull it over. And maybe whatever was the pressing need for you to immediately buy something or sell something a couple of days ago will all of a sudden not be as maybe something that you don't think it is that good of an idea anymore. All right. The other really important lesson, and one of the problems that I sometimes have is sort of this reflexive reaction to bear markets. Oh, zoom out over the long term, it's great, is that the impact of every bear market is very unevenly distributed among investors. And the reason for that is we all have different goals. We're all at different stages of life. And a bear market can be really devastating if you are transitioning into retirement, right? We talk a lot, or I talk a lot about on here about sequencing risk. Can't speak for some reason. Sequencing risk, of course, is the order of the returns you have matters, right? So it's fine for me to show a slide like I did a couple slides ago and zoom out and talk about, obviously nobody has this time horizon, but talk about what happened between 1870 and 2022. Like, that's great for me to do. But if you're retiring in early 2000 and you are faced with a huge market loss and then a decade of negative returns, that's really not a good thing, right? So even though your average return will be the same as, somebody who potentially is younger, the fact that you are retiring and having to liquidate your portfolio in order to support yourself every year has a lot of implications. It means that you're going to run out of money sooner, which means you potentially could outlive your money. So it is important for us all to remember that depending upon where we are in life, what our goals are, what our personal financial situation is, that bear markets can be really devastating. And that is why we want to lower volatility in portfolios if we can't afford to retire into a bear market, if we're getting very close to our goal, and just being cognizant that a bear market does occur every 3.5 years. And we have to remember that over the long term, we are getting higher expected returns from shares, right? That's why we invest in shares rather than, let's say, cash or bonds. But the reason you're getting that longer return, nothing in life is free. The reason you're getting that long-term higher return is because over the short term, you can be faced with a lot of volatility. And that's what we're experiencing now. So if you are younger, well, that's fine, right? That might be the price that you are paying halfway through saving and investing for retirement. If you're just going into retirement, you have to be cognizant that if something like this happens, it can really impact your life and really impact your ability to have enough money to support yourself throughout retirement. So it just is important to remember that it is the actions you may take in a bear market are not necessarily going to correspond if you're about to retire as if you're a 30-year-old that has a very long time horizon. So something important to remember. All right. This is our last lesson, actually. Okay. I've heard, and I'm sure we have all heard, that people have decided to, of course, sell into the bear market. That is why the market goes down in the first place, right? People are selling. And it's kind of a common thing that we always hear that, okay, what am I going to do? I'm feeling very stressed as an investor. I am maybe watching my account balance go down every day or every week. We had a big run of negative weeks in a row. And that, of course, is a very stressful time for any of us. And so a lot of people in, sort of the desperation to get rid of that stress, of course, decide to sell. And they decide that that is going to be their response to what is happening. And it is perfectly natural. That's the first thing to remember. This is a perfectly natural feeling. And just because it's perfectly natural, of course, does not mean we should do it. So I hear a lot, and I think you guys probably hear a lot, that things are really unsettled right now, right? We've got a war in the Ukraine, we've got inflation, we have central banks raising interest rates. There's all this talk about whether the economy is going to go into a recession, soft landings. We're hearing a bunch of stuff. It's very unsettling, right? So a lot of people naturally think, okay, well, logically then I should sell and I'll get back into the market when things have calmed down. And that sentiment is, something that I think is sort of universally appealing to all of us. It makes sense, right? Things are going badly now, so I'll just take some cash out. Things can keep going badly, and when things are going to keep going badly, then I'll just get back in later. Now, the problem, of course, is that this is extremely difficult to do. And the implications of getting this wrong on your long-term returns are huge. All right, so let's talk about the market in general. And then we do have a question. I'll get to that in a second, Lisa. Thank you for asking that. Let's talk about the market in general. So the market, of course, is forward-looking. And I think people always make that comment, but don't necessarily understand the implications. But yes, the market is always looking at the future. And very simply, what that means is how the market performs is not necessarily indicative of how the overall economy is doing, right? So if we go back and we look at, and we'll look at an example of this in a second, but even think about what's happened this year. When January 4th, when we hit that high before the fall, we think about the commentary out there, all of it was pretty rosy, right? So at the end of the day, the commentary was, hey, there's some inflation, but it's transitory. It'll go away. It's all related to, COVID bottlenecks, and we'll work our way out of that. And then all of a sudden, stuff started to get very negative as inflation continued to stay high and keep going up. And as central banks became more and more aggressive in their response to it. So, right now, if you look at the market in general, right, the market is once again looking forward, and the market's trying to figure out, and a lot of the volatility we've seen, trying to figure out, okay, are we going to get pushed into a recession based on these central bank policies, right? Inflation keeps going. We keep getting these interest rate rises. Are we going to get pushed into a recession? So just remember that the market's very forward-looking, and I'll use an example of this. But Bank of America went back. They went back and they looked in 1930 S&P 500 returns. And if an investor missed the 10 best days each decade, they would have a return since 1930 of 28%. If they stayed invested the entire time, their return would be 17,715%. So that's a different percentage. And remember, a lot of these rallies, as we showed on this previous slide, we're talking about these best days. So the strongest days, half of them occurred in the bear market, 34%. So we're talking 84% at this point occurred before anyone realized we were back in a bull market. So the market had hit a low, but we of course don't know it's a bull market until it hits another high. So a lot of these days, this volatility that happens in bear markets, bad and good, a lot of this stuff is happening right now. And so if you miss those, the implications, as you can see, are obviously huge. Something pretty important. I'll get to the questions in 1 second, but I do want to go back and look at the GFC. I found this, nice little chart. But if we talk about the GFC, so the market fell to an extreme level during the GFC. But if we go back there and look at when the market turned and what the implications are of when the market turned. So the market actually bottomed out. Once again, nobody knew this at the time. So the market bottomed out in March of 2009. So at that time, nobody knew what was going to happen with the economy. So in fact, we still had another quarter to go at that point of negative economic growth. So the recession was continuing. And once again, we don't know the second we come out of a recession. We can look back historically, but remember, you're not getting GDP rulings or readings for months and months and months after a quarter closes. So we don't know that we're even out of a recession. The other thing that happened is unemployment. So US unemployment rate actually peaked in November of that year. So the market bottomed out in March unemployment kept going up to 10% in November, and then took a very long time for it to come down. So it seemed like a terrible time. So there was certainly no indication. So this idea that people have around market timing, I'll just get back in when things feel safer. Well, when did they feel safer? Could be years later when things finally, quote unquote, feel safe, and you're missing a lot of returns. And this was, a particularly sort of steep rally that's pictured on that chart. But if we go back and, we look at that time period. So if you went from March to when the recession officially ended, and that was that September quarter, right? We didn't even get the GDP for months later, but the market rallied 40% in that time between that low in September. So even if you had a magic way to figure out that the recession was over the day that it ended, well, still, you missed 40% of returns. And that is a big deal. And that's why we have these huge differences in returns. So something to think about. All right, we've got a couple of questions. So send through some other questions. So my question from Bronte, are there any common traits that show a market turnaround, volume, etc.? No. I mean, honestly, they're really like, there are a lot of different people that are looking for what indications are that we have, in fact, hit bottom, or at least are getting close to bottom. There really isn't one. A lot of the sort of the famous quotes that we hear talks about sort of investor sentiment, and that when it hits a low and nobody wants to own shares anymore, that's when the market turns. Now, this, of course, is like, it makes for a good quote, like, don't buy until blood is running in the streets. Well, blood's not actually running in the streets. And there are a lot of people that still own shares at the bottom of every market. So stuff like this is very, very difficult for us to read. And I think we can go back, just like with a bubble, right? Just like a bubble, there's no exact indicator that we're in a bubble. Only in retrospect can we figure that out. And yeah, there were a lot of people that were talking about the crazy investor behavior that we've been seeing since 2020. But once again, it's only a bubble in retrospect. So yeah, unfortunately, not any real indicators. I think what I would do is, focus once again on what your goals are, why you are investing in the first place, and see if securities are actually attractive compared to that goal. So whether you are focused on, if you're an income investor, what have we seen with the huge run up in shares? Well, we've seen dividend yields drop. So maybe it didn't make sense for you. Maybe you couldn't think, at least like in a US standpoint, but Australia dividend yields are also kind of, they're higher, but also really low. If we look at where they've been historically, hey, maybe you sit there and say, I don't think it's worth it to invest, but I'm getting a 2% yield. If the market keeps falling, that yield goes up. Maybe that's a good time to invest. So I would just sort of focus on fundamentals. Don't focus on the action of the market, because you're never going to be able to figure that out. And actually the market action is going to cause you to do probably dumb things that are detrimental to your long-term wealth. So Lisa's asking, does a bear market make an overly expensive share value more realistic? Well, yes, but there's a caveat to this. Depends upon the bear market. So we saw very high. We had the second highest. If we look at the cyclically adjusted price to earnings ratio, and I know I always talk about this thing. What that is there's cyclicality to earnings. Right. So as the economy does well and the economy does poorly, that natural economic cycle, even if you don't fall into the recession, that natural economic cycle, earnings are going to vary over that. Right. So when we're looking at valuation levels, both the earnings and the price are moving all the time. So we got to remember that. If we look at the CAPE ratio, cyclically adjusted price to earnings ratio, that takes out that cyclicality by looking at the average earnings over a 10-year period, sort of marching that forward. We look at that in January, the market was the second most expensive it's ever been since we started measuring a CAPE ratio, which is the late 1800s. Now it has come down, certainly, and really where the market's kind of sitting now, if you look at that CAPE ratio, it's at about an average valuation level from, if we look at the year 2000 on. So valuation levels have been higher. more recently than they have in the historic past. We go back and we look at where we are. Yeah, we're about average. So I certainly wouldn't say that the market is cheap, but we have seen valuation levels come down. But one of the important things to remember, Lisa, is that bear markets, about half the time, as I said, do accompany a recession. So when a recession occurs, you are going to have drops in earnings. So the market doesn't necessarily, once again, look that cheap at the time if something like that happens, right? If we are pushed into a recession by these higher interest rates and central bank actions, the market may not seem that cheap at the time, but it certainly could be cheap if we think about the cyclicality of earnings or we think about them coming back. But yeah, valuation levels are better than they were. I think, once again, it's always, anytime you're investing, it's sort of a risk and reward, balancing act there. So I think it's just people saying, okay, well, what rewards do I think is going to happen versus sort of the risk of an average valuation level. Okay, so Joan says, I've heard a suggestion that if a 5% rally is sustained, it is time to start investing. Are there stats that support this? Okay, so what I would argue, and this is my philosophy, and Morningstar's philosophy, is looking at price movements is a terrible reason, no matter what, to invest. So looking at markets, and there's certainly a lot of people that are adherents to sort of technical analysis, where we're drawing lines on charts and trying to figure out where the market goes. Like, I think looking at any market movements is a terrible reason to make a buy and sell decision, because that is why we make such poor decisions as investors. That the average person, when they're sitting there deciding whether they want to invest in an ETF or a fund or an individual share, is sitting there and saying, okay, well, this ETF performed well, so I'll invest in it. That is not a good reason to invest. That is why we chase performance. That is why we have this behavioral gap. So I would suggest that, I'm sure you have heard this, and I'm sure there potentially are some stats to back that up. Remember, those are all back tested, right? Like, we go back and we look at what's happened in the past and we try to find patterns. That's sort of what humans do, right? Like, we certainly do it. We certainly do it, obviously, by just crunching data, but we also just do it with our own lives, right? We're trying to put narratives around random acts, and market movements are pretty much random acts at the end of the day. So we're always trying to create this narrative, or we're always trying to create a story about why something happened. Why did the market start going up? Well, this 5% rally was sustained. So it's not the technique I would take, but yeah, I'm sure there's some data somewhere to prove that out. So Nicola has a question. Are there particular sectors of the market that you expect will turn around first after this bear market? Okay, so traditionally what has happened does not mean it's going to happen now, but traditionally what has happened is when you start getting out of a bear market, which, once again, we do not know when that occurs. We will not know that it has occurred for potentially 19 months later, right? So when we're talking about the official end of a bear market, historically, we can look at that, low date. We do not know that the bear market's over until we actually hit a new high. That's when we can go back and say, okay, the market hit a low, now we're back at a new high. So now we can define the bear market. So remember, it can be quite some time, 19 months, right, was the average after a bear market ended, before we knew the bear market ended. But historically, what has done well when the markets have turned around has been sort of what we would consider kind of riskier, more volatile things, like small cap stocks, for example. So generally, small cap stocks rally a lot harder, they fall a lot more when we're coming out of a bear market. So probably, that's what I would say. We start to look at sort of from a business risk perspective. We talk about business risk a lot, the uncertainty rating we have at Morningstar. So probably a lot of that stuff that is higher business risk generally does better coming out of a bear market, and generally falls more, right? And we continue to fall more if things continue to go down. So yeah, that's kind of what I look at. I'd look at, especially if there's a recession, then of course you have companies that are more cyclical. This is all stuff I don't like to invest in, but companies that are more cyclical, right? So companies whose fortune is going to follow the market cycle. Companies will do very well if the economy is doing really well, will not do well if the economy is doing poorly. Generally, those companies would perform pretty well because as we're coming out of that bear market, right? Like there is optimism. If there's a recession associated with it, it's probably ending, right? If we think about that 2009 example, right? The recession was ending, the economy was getting better. We just didn't notice it yet. But what's going to perform well in that is some of those cyclical companies. So if we go and we look from a sector perspective, you can go and look at it, stuff like building materials and things like that, things that are sort of inputs into the economy, financials, stuff like that. All right. So we've got another question. A very specific question that I definitely cannot answer. If you email that to me, so it's why are bank cap notes of 2.9%? Email me that question. I'll try to find an answer for you, but I can't answer it right now. Okay, so we've got a question. Is it okay to get into the market during a recession or not? Yeah, I mean, listen, once again, it depends what your objectives are. Investing in a lower valuation market is safer than investing in a higher valuation market. We just don't know it, right? So when do people, we have recency bias as humans. So when the market has done very well for a long time, we all think, oh, okay, it's really safe, right? So that's when at the top of markets, if we go back historically, at the top of markets, that's when a lot of individual investors and a lot of institutions and everyone else starts investing. But particularly individual investors, we see this huge surge of interest from investors when the market's done really well, of course, because, and think about it, it's human nature. You're sitting around, you've got a friend or a family member that is investing, they're sitting around talking about how well they've done. Well, you're going to start to get interested in that, right? And so people perceive lots of years of above average returns. They perceive that as safety. But in fact, that's not true, right? That's pushed valuation levels up, which lower our future expected returns. I mean, the market is riskier, right? Conversely, if the market's doing very poorly, if we're in potentially a recession, valuation levels are lower. People think the market is really risky because it's fallen. Once again, that recency bias, but the opposite's true, right? So, I'll say this with certainty that the market over the long term, it's safer to invest now than it was in the beginning of January, right? Because those valuation levels have come down. Now, it doesn't feel safer and doesn't feel safe every time we pick up the paper and read about recession risk and inflation and all these horrible things that are happening. It doesn't feel safer. In actuality, historically, it was a safer time. All right, so the anonymous attendee said, we have established buying and selling to time the market doesn't work. Is it better to invest at a consistent linear rate over the long term, $5,000 every 2 months, or only invest in the bear market, hold and save cash outside the bear market, invest to save cash in the next bear market? Okay. Really, really good question. I really like this question. Okay, so let's unpack this a little bit and talk about some of the different components in this. So there is this large debate that goes around dollar cost averaging versus lump sum investing. And basically what we're talking about between those two things, dollar cost averaging is what you're describing there. Is it better to invest at a consistent linear rate over the long term, $5,000 every 2 months, or lump sum investing, save up, and then invest only when we're in bear market? So a couple of things I'd say about this. Number one, I think it's important, obviously, to start with your goals and what you're trying to achieve. I think it's also really important to look at where you are in your investing life cycle. So, and we are actually recording a podcast episode right after this where Shani and I are going to talk about sort of do our mid-year or end of financial year, however you want to put it, portfolio checkup. And, Shani, as she constantly, and Shani's my colleague for people who do not know, Shani, as she constantly reminds me, is a lot younger than me. So when you are younger and you have time on your side, my guidance would be, okay, that might be a time where you might want to just get as much money into the market as possible, right? Realizing that you have that extremely long time horizon. And for most people, they don't have a bunch of money sitting around, so they're investing at every paycheck. All right, and that's what Shani does. Like every paycheck, she is investing, she understands her goals, she understands the return that she needs to get over a very long time period. Now, she likes to say, significantly older than Shani. And so I will say that I have been, and I've been honest about this, I've been building up cash over the past couple of years because that valuation level, I was uncomfortable with it. So I've got about 25% cash now after the last couple of years. Now, what I would say about that is the reason I did that, even though that is in a way timing the market, which is what you're talking about, investing in bear markets. The reason I've done that is because I established my goals. I, as someone who's older, have more money, but less time than someone like Shani, who her huge advantage is time. That's why she's trying to get money into the market. Because I have more money, just because I'm older, the more money that I have means I was already on track to achieving my goals before I did that. So I knew that more cash in my portfolio, I was still, if the market kept going up, and I had no idea when it was going to stop going up, market kept going up, I would be fine. I'd still achieve my goals, even by building up cash. So, that's sort of my answer. What I would say that this hold and save cash, remember, it's a very difficult thing to do, to sort of time that correctly. And, yes, I am trying to figure out a time where I'm more comfortable with valuation levels, but I'm not going to look at sort of where the market is. I'm going to try to focus on valuation levels, dividend yields, price earnings ratios, things like that. So Peter's asking, what is your email address? I mean, Peter, you have to at least buy me a drink first before you ask my email address, but it is mark.lamonica1@morningstar.com. So the invite that you got and the reminder you got for this webinar, my email address is on there. So send me an email if you have any questions. Okay, really good question from Napesh. What is the technical definition of a bull market or a bull market? 20% up from the bottom? Yes. So basically 20%, and remember, 20% is a very arbitrary figure. Somebody decided that 20% represents a bear market, 20% represents a bull market. But yes, that is the answer right there. So we're looking for 20%. All right. I've received a message from Emily. Very polite. Emily is on our team here. She's sitting over there by the window, enjoying the rain. She does not like it when I point at her during these things, but she's at least laughing. She wants me to ask people to send through additional questions they have. So we're going to do a Q&A webinar on the 25th of August. So if anyone has any questions they would like answered during that, you can send that through. All right, I think we've gone through. Somebody said, hi, Mark. So I will say hi back. If you have a question, hurry up and type it in, and I can try to answer it, or we will have to end this thing. Anyway, send the question through to my email, mark.lamonica1@morningstar.com. Well, thank you guys very much for joining. I appreciate it. And we'll be back on Tuesday doing this whole thing again. So I hope everyone has a nice day and a nice weekend.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.